Hey everyone, Dave Pettit, Mortgage Planner, here to talk to you today about PMI, Private Mortgage Insurance. What is it exactly? You've heard that term. Today we're going to take a deep dive for the next 15 to 20 minutes and talk about exactly what PMI is, who it benefits, etc. Before we jump in, I just want to take a quick second to give you an outline of what we'll be talking about today. First, we'll talk about what private mortgage insurance is, when can it be removed, the PMI options for the different loan types, and then we're going to talk options, and more options for conventional loans like a monthly premium, a single premium paid by the borrower, often referred to as borrower paid mortgage insurance, LPMI or lender paid mortgage insurance premium, and the split premium option. So hang in here with us as we go through all of these different options, and again, the point of this is just to show you that there is not a one-size-fits-all approach to mortgage insurance. Now let's dive in. So private mortgage insurance is actually a special type of insurance policy provided by private insurers to protect a lender against loss if a borrower defaults. So you heard that right. It's to protect the lender. It's not to protect you. That's one of the common misconceptions with private mortgage insurance. When is private mortgage insurance required? Well, in a nutshell, we're going to talk mostly today about conventional loans. So your Freddie Mac, Fannie Mae, typical conventional mortgage. And that's required anytime you are putting down less than 20%. So if you're buying a home for $100,000 and you're putting down anything less than $20,000, then you have to have mortgage insurance. But that can come in a variety of ways. You'll notice in bold here below I've got traditional PMI. Cost can range from 0.25% to 2%, but typically run from 0.5% to 1% when we're talking about conventional loans, and that's of your loan balance per year. Now I highlight traditional, and we'll talk about that a little bit more in detail just to help understand that more exists than just the traditional options. One of the first questions that we get when we're talking about private mortgage insurance or PMI is, when does it fall off? When can I get rid of it? Well, to read here, once the mortgage's loan to value or LTV drops to 78%, meaning your down payment plus the loan's principal balance that you've paid off equals 22% of the home's purchase price or original appraised value, the lesser of, the lender must automatically cancel that PMI as required by the Federal Homeowners Protection Act. So even if your home's market value has gone down, they are required to remove that by law once you hit that 22%. So for example, on the $100,000 that you purchased a home for, you've paid the loan down to $78,000, they have to drop it. Now that's conventional lending, and we'll talk about the other loan types here shortly, but one other thing to point out is on a conventional loan, you can actually request from the loan servicer that they do drop that mortgage insurance once you've hit 80% of the original value. They can do that. It's at their discretion. One of the common wives' tales that I hear all the time is that I can ask the servicer to drop my mortgage insurance just because home values went up. So say I bought that home for $100,000, I've paid it down to $90,000, but my home's worth $150,000 now. I can ask the lender to get rid of it. You can certainly ask, but in my experience, lending since 2003, I've never seen a servicer drop that. Now with FHA, it's a little bit different. We'll touch on these other loan types, but FHA today, and this changes from time to time, but today, with less than 10% down, you have an annual renewal fee, HUD's version of PMI, for the life of the loan. With 10% or more down, it falls off after 11 years. VA has no reoccurring annual or monthly fee, and USDA, also like FHA, has an annual guarantee fee divided out monthly, and that is for the life of the loan. Now let's talk about FHA loans for just a second. FHA is pretty straightforward. You can see from this table below that if I were to purchase a home for less than $625,500, I put down only the 3.5% minimum requirement, so my loan to value is greater than 95%, that my annual renewal fee would be 0.85% of the loan amount divided out monthly. So that's 0.0085 divided by your loan amount, and then it would be for the duration of the entire loan. If I were to put down greater than 10% or greater, it would be 80 basis points or 0.008, and it would fall off at the 11-year mark. Okay, and this chart will go through and show you exactly if I do a loan that's 15 years or lower in term, and I put down a big chunk of money, so I put down 10% or more, 45 basis points for 11 years, and that's just because they assume that the risk is a little bit less on a shorter term loan. One other thing to point out about FHA quickly is that FHA also collects an upfront premium of 1.75%. Now this is all subject to change. FHA is constantly reevaluating this, but it's been set this way for quite some time. So 1.75%, if you were again to borrow $100,000 in your base loan amount, they would tack on 1.75%, and that would become your total loan amount and the amount that you would borrow. So that 1.75% is factored in to the total loan, and then annually you still have the renewal fee. VA is a little bit different in that there is no annual renewal fee. There's just a one-time fee. And you can see on their chart here, if I were regular military, I'd never used my VA benefit before, and I didn't put down a single down payment, I would be in 2.15%. Much like FHA, they tack this on to the base loan amount. That becomes your total loan amount. But then again, with VA, there is no annual renewal fee. It's just a one-time premium. USDA, or rural home loans, operate like an FHA loan. They collect an upfront premium, and today, or as of the fiscal year 2017 and still today in 2018, they collect a 1% upfront guarantee fee and then a 0.35% annual fee, and that's for both purchase and refinances. For example, if I were to borrow, in this case, $200,000, the upfront fee would be 1% or $2,000. That would be financed into your total loan amount, and then the monthly fee would be based off of that total loan amount, adjusted annually. So $202,000 in this case times 0.35% equals $58 a month, and that's what you would pay as a line item in your monthly payment. I say adjusted annually, and all mortgage insurance really is adjusted annually because it's based off of your loan amount. It's not based off of the original loan amount, it's based off the current loan amount. So that will go down over time, and the mortgage insurance premiums will adjust down over time as well. For the bulk of our time today, we'll be talking about private mortgage insurance on conventional loans with less than 20% down. I say less than 20% down because, as we know, when you put down 20% or more, there's no mortgage insurance required at all. But the agencies, Fannie Mae, Freddie Mac, do require that whenever someone put down less than 20%, that there be mortgage insurance. Now, the traditional method is in this first column here under monthly. Monthly, or the traditional, as I highlighted in the first slide, is where the annual premium is paid divided out monthly. Most lenders, most banks, this is the only way that they're going to talk about mortgage insurance. It may be all that they know. It's the way that it's been done forever. And it may make sense in some cases, but we're going to contrast that with a few other options. The first option we'll talk about is borrower paid single premium, often referred to as BPMI, so borrower paid mortgage insurance. This is where you pay up front, or in some cases finance the premium in one lump sum. So it's a one lump sum payment. You never have mortgage insurance as a line item ever again, but it's at your cost. LPMI, on the other hand, or lender paid mortgage insurance, is where the lender, us, pays the one-time premium with yield generated from a slightly higher rate. So the rate goes up a little bit. We use that to pay for this one-time premium that you would have paid for under example 2 here, and you never have the mortgage insurance as a line item. This is often referred to as a no mortgage insurance loan as well. In reality, there's no such thing as a no mortgage insurance conventional loan, but lender paid mortgage insurance is often called that because it doesn't appear to you that there is any mortgage insurance at all, although the lender is taking care of that behind the scenes. The fourth option that we'll talk about is not a very common one today, but it's the split premium option, and it's kind of a combination of number 1 and 2 here. This is an option where there's a portion paid in a single one-time lump sum and then a monthly portion paid on the balance. To give you a couple examples here and help you understand, if an annual premium was 0.08% and the loan amount was $200,000, the monthly amount would be $200,000 times 0.008 divided out by 12 months, or $133. If you paid that in a single premium, you may get that for as little as 1.75%, pay $3,500 up front, and never have a mortgage insurance payment again. We'll talk a little bit later about when these make sense, but just to give you some more depth on this, under example 1, we're going to look at monthly mortgage insurance. We're going to use a $200,000 loan on all of our examples with 5% down, and then again with 10% down. And these are all 30-year fixed rate mortgages. on conventional loans with less than 20% down. So first we'll talk about monthly with a few different credit scores. A 740 credit score is going to give us a factor of somewhere in the ballpark of 0.59%. We times that by our loan amount, divide it out by 12, and that would be a monthly premium of $98.33. With a 720 score, there's a little bit more risk to the mortgage insurance company, so that factor goes up a little bit. The bottom line goes up as well, $121, so on and so forth. With a 700 credit score, $145, $680, $180. Now, when we put a little bit more money down, under this next example with 10% down, the risk goes down to the mortgage insurance company. So they in turn reduce that factor, 0.41%, so we drop from $98 to $68, again, based off of our loan amount, and that's reduced annually as you pay down the principal. 0.5% here on a 720 credit score, $83 a month. 700 would go up to 100, 680 to 121. So as the credit scores get lower, the factors go up as the mortgage insurance company assumes that there's more risk associated with that. But the factors do go down the more that we put down. Let's talk about, in example number 2, a borrower paid or BPMI single premium. Same scenario, $200,000 loan with 5% or 10% down. If I have a 740 credit score and I want to do the borrower paid single premium with 5% down, I'm going to be somewhere in the ballpark of 1.75%. If I put 10% down, that factor is going to go down, and so on and so forth. With a 720 score, 700 score, 680, the factors are going to rise, and they will go down accordingly with the more you put down. That's just the risk assessment, okay? So a couple things that are really important to note here. One is that, to take it back to the previous slide, these factors will change. The mortgage insurance companies re-rate often. They used to say about annually. Now it seems like monthly. They're competing with one another. So that's one of the benefits to working with a mortgage professional. We'll shop all of the mortgage insurance providers to make sure that we're getting you the best possible rate. Important to note that the difference, the space between these, so in this example 0.59 or 0.73, about 14 basis points, that space seems to stay about the same. So maybe today I can get this mortgage insurance with a provider for 0.5. That would still mean that with a 720 score, I'm probably somewhere around 0.64. So the space between these kind of coincides with the Fannie Mae loan level price adjustments, and they don't vary quite as much as the actual rates themselves do. Okay, in the third option, we're going to talk about lender-paid mortgage insurance. Lender-paid mortgage insurance on the same scenario would not give you a monthly payment. It would not charge you anything up front. Rather, it would add a little bit to your rate. So for example, if I was at 4.75 on the previous two examples, I may be at 5.125 on this. So a 3/8 add to the rate on $200,000, about $44 a month. So instead of paying $98 a month or paying $3,500 up front, I could just opt to have my payment kind of be in between the two. Take a little bit higher rate, $44 a month, and an increase, and maybe that makes the most sense. And we'll talk about when some of these might make sense or make the most sense for you a little bit later. With a 720 credit score, 5/8 add or $73 a month, a 1% add at 700, 1.375 at 680 here, and then as we put more money down again, typically it's going to reduce the addition to the rate. So maybe a half add versus 5/8, 0.75 versus 1, and it's going to increase just accordingly a little bit less. So that's the lender paid mortgage insurance and how that works. Let's talk about split premium, example number 4 here for just a second. Not a really popular option, not like the other three. It just doesn't seem to be enough bang for the buck right now. That's not to say that it won't be later, but what they require in this scenario is that you put down a one-time premium of 1%. So 1% of the loan amount. Under each one of these scenarios, we're putting down $2,000. And then the factor, the mortgage insurance factor, reduces accordingly. So instead of paying $3,500 up front, we're paying $2,000. Instead of having $98 a month in mortgage insurance, we have $61 under this 740 credit score example, and contrasting that with the other examples. So 1% across here, 0.51%, 0.65% going up with the lower credit scores, and then down here going down with the increase in down payment. So 0.15 all the way to 0.47, $25 a month to $78 a month. But again, that's putting down the $2,000. So what does all this mean? If I have a 740 credit score, I have 5% down, what do these options look like? Well, I can opt to pay $98 a month and not put down any additional funds. I can pay $3,500 and never have a line item for mortgage insurance. I can have my rate go up $44 a month and not pay monthly mortgage insurance, or put $3,500 up front. Maybe that makes the most sense. Or we can look at the split premium as well. This is the important part that I want you to look at. Under this scenario, monthly mortgage insurance or split premium would fall off in approximately 104 months. Okay, so that's just under the normal amortization. If you never accelerated your payments, never made additional payments, it would come off in 104 months. If you paid a one-time fee of $3,500, your break even at $98 a month would be 35.5 months. So you come out ahead in this scenario. If you were to keep that home for 104 months, you actually come out ahead by 68.5 months. So when would that make sense? Well, that might make sense in a really good competitive interest rate environment where I'm getting a really good rate, I've got great credit, I've only got the 5% to put down, but I'm planning on being in this house for at least that 36 months, but more like 5 to 10 years, or maybe it's my forever house. That's when it would really make sense to look at that borrower paid single premium, the one-time premium. If you chose LPMI, you still save approximately $54.33 a month over the $98 for the first year, and close to that for 104 months. And I say close to that because remember the mortgage insurance adjusts with the loan amount. Where you lose with the LPMI is if you keep that same loan for longer than 104 months. So lender-paid mortgage insurance is a really popular option right now today because interest rates have risen a little bit. It's probably not the loan that someone's going to have forever. There's probably going to be some good refinance opportunity in the next couple of years. So lender-paid mortgage insurance makes a lot of sense. If we were in that really competitive interest rate environment where I'm getting a really low loan and I think I'm going to be there for a long time, LPMI would not be the option that I would want, because after that 104 months, I'm basically stuck with that higher rate for the life of the loan. You might ask, when does the monthly mortgage insurance option make sense? Well, again, if I'm in an environment where interest rates are a little bit higher, there's a good chance that I'm going to be able to refinance in a little bit, but I don't want to put down a chunk of money up front, and I have a lower credit score, so the lender-paid mortgage insurance isn't a great option for me either, because it's going to take the rate so much higher. It might make sense to do the monthly mortgage insurance, but just understand that that really is not the only option. Under example 2, with the 700 credit score and 5% down, let's look at our options. I can pay $145 per month. I can pay over $6,000 in a one-time premium, which seems really high, but let's look at what that really means below. I can do the lender-paid mortgage insurance, add 1% to my rate, have my payment go up $119 a month versus $145 a month. Or I could do the split premium as well. Under this scenario, monthly mortgage insurance would again fall off in approximately 104 months. If I paid the $6,640 at $145 a month, my break-even's only 46 months, so less than 4 years. So again, if I'm getting a really good rate and I know that I'm going to be in this house for a long time, maybe the $6,640 makes sense. You still come out ahead 58 months over just the monthly mortgage insurance, should that be the best option for you. If you choose the LPMI, you still save $26 a month for the first year and close to that for 104 months. Again, where you lose with the LPMI is if you keep that same loan longer than the 104 months. So LPMI, again, great short-term plan. BPMI, if you get a really good loan with a good rate, it's a fantastic long-term plan. Let's look at some payment examples to bring this full circle. So again, I have a 740 credit score, 5% down, 30-year amortization, I'm borrowing $200,000 at a rate of 4.75%. My taxes and homeowner's insurance is included in this estimate, and those will of course vary region by region, but I've opted for the monthly mortgage insurance option. My total payment is going to be $1,300.16. Now, I'm thinking that this is a place that I might be for quite some time. I've got a fantastic loan, and I want to do the borrower paid single premium. What happens is that is removed as a line item in the monthly section because I've paid $3,500 up front, and my total payment drops down to $1,218.29, so almost $100 lower than the monthly option. But then I rethink it and I say, well, I don't know that I'm going to be in this house for very long, and it might not make sense to put down the $3,500 up front, but I don't want the monthly mortgage insurance option knowing that that's the highest. I really don't think I'm going to be here longer than 5 to 10 years, so let's look at the lender paid option. What happens here is we still don't have a line item for the private mortgage insurance, but we do increase the rate by that 3/8 so that we can use the margin as the lender to buy out the one-time premium. That changes your payment down to $1,263 and effectively splits the difference between option 1 and 2. The last option under the split premium is that I pay the $2,000 up front. My annual factor is reduced down to a $61.67 monthly payment, and my total payment drops to $1,279.96. I hope that this helps understand a little bit better why understanding your options when it comes to mortgage insurance is so important. There is no one size fits all. Everyone's scenario is a little bit different, and each of these options may make sense for someone depending on their situation. In closing, Dr. Ben Carson said, "I'm convinced that knowledge is power, to overcome our past situations, to fight new obstacles, to make better decisions." I hope that you feel that our time's been well spent today. I hope you feel empowered with some new knowledge about mortgage insurance so that you can find the right product for you that makes the most sense for your situation. We appreciate you taking the time today and are always here to help with any questions.